Welcome back to AI Research. Today we are diving deep into the relationship between the stock market and the money supply, and why the current levels are flashing a major warning signal. We've seen the media shouting, AI bubble, 24/7, but to understand if the danger is real, we have to look at the S&P 500 M2 ratio. This ratio tells us if the market is growing because of real value or if it's just decoupling from the actual cash available in the system. 1. The historical context. A new peak. As of late 2025, the ratio has reached 0.30. To put that in perspective, look at the timeline of how stocks have decoupled from the money supply. Period. Ratio level. Market context 2017 to 2019. 0.17 to 0.20. Balanced growth. Mid-2020, 0.16. High liquidity, market panic. January 2022, 0.22. Peak of post-stimulus rally. Late 2025, 0.30. Historical high. Stocks decoupling from M2. This 0.30 level is a historical high, mirroring the peak of the dot-com bubble. It is a dangerous zone. 2. The 50% overvalued calculation. You might ask, how do we get to the conclusion that stocks are 50% too expensive? If we assume the fair value or stable baseline for the market is a ratio of 0.20, the top of the 2017 to 2019 range, but we are currently sitting at 0.30, here is the math. Essentially, for the ratio to return to normal, without stock prices dropping, the Fed would have to print roughly $10 trillion more, increasing M2 by 50%, while stock prices stay exactly where they are today. If that liquidity doesn't arrive, the market is effectively unjustified by the available cash. 3. Why focus on M2? The fuel tank. To understand the risk, you have to understand what we are measuring. Economists use M2 as the Goldilocks metric because it represents the money actually available for people to invest. M0, monetary base, just physical cash and bank reserves. Too narrow. Most stock buys are digital credit. M1, spendable money, cash and checking accounts. Since 2020, this includes savings, making it very volatile. M2, the sweet spot, includes M1 plus savings plus money market funds. This is the total fuel tank retail and professional investors have ready to deploy into the S&P 500. M3, M4. These include institutional repos and large time deposits. The Fed stopped tracking M3 in 2006, making it too opaque to use for daily analysis. Note on money market funds, MMF, these are near-money assets. Think of them as super safe mutual funds buying short-term government debt. They aim for a stable $1 price. When M2 is high, the fuel tank is full. When the S&P 500 M2 ratio hits 0.30, it means the valuation has outrun the liquidity. 4. The 2020 accounting shift, M1 versus M2. It is vital to remember that in May 2020, the Fed changed the definition of M1 by moving savings deposits into it, due to the removal of withdrawal limits. M1 saw a fake vertical spike because of this paperwork change. M2 remained a constant and reliable metric because it already included those savings. By using M2 for our ratio, we avoid the fake crash signals that M1 would provide. However, stocks and bonds themselves are not part of M2. They are financial assets that fluctuate in value. M2 is the cash used to buy the stocks. 5. The conclusion. The danger today is that the visible money supply, M2, can no longer explain why stocks are so high. Either there is hidden institutional liquidity we can't see, or, more likely, investors are paying a massive speculative premium. When the ratio hits 0.30, the market is effectively out of gas. Alright, this is the AI Research. If you find any value in this, subscribe for more. See you in the next video.